I've given you one more variation of this when we say zero cost. Now, this example is not exactly zero cost, but what is happening is see, when you take positions into an option, you have to pay a premium at the start, right? Suppose if I create a structure, a complex product, suppose, in which I don't have to pay the premium now. I will pay the premium at maturity. I will pay the premium at maturity. So that is the reference of that is an example that we are going to be talking about. Okay. Suppose we have created an option as a zero cost. Okay. Okay. Normally what happens is, if suppose it's a normal option, the upfront premium has to be paid. But if suppose I'm creating this option where the upfront premium can be deferred till the expiration of the option. So right now, when you're entering, you're not paying anything. You're buying an option, but you're not paying anything. Okay. So suppose I'll give you a basic example. So there is an A as a reference. Okay. What is the total payment? Okay. So whatever was the premium that buyer was supposed to pay, he's not paying that at this zero time. It is going to get increased and paid at a later point in time. And the payoff is going to be like this. So I will take an example now. I will take an example of how exactly it looks. Okay. So in a normal option, what happens is, suppose if time 0 and time 1. Okay. What generally happens is, you have to pay a cost. Now this cost is represented as C. You have to pay cost right now at time 0. Okay. But suppose if I come to you and say that, okay, don't pay C now. Okay. Let us assume this is a number of 100, 10 basically. Okay. And you don't have to pay the cost now. You have to pay the cost later. Okay. Later means at the maturity. So what you will have to pay is, you'll have to pay an amount called A, which is nothing but the growth amount of C. So you will take C, and whatever is the interest rate, you will just multiply it with the amount. So suppose if the rate of interest is say 10%, okay, then ideally the structure will look like this: 10% raised to 1. 10% raised to 1. So what will be the final amount that I have to pay? $11, right? So what I'm saying, I have created an option now where at the start I have to pay nothing, but at maturity I will have to pay 11 rupees. Okay, at maturity I will have to pay 11 rupees. Simple. Now when I reach at maturity over here, okay, I'm just writing it as M. Okay, suppose if the strike price, I'm just highlighting it over here, suppose here the strike price was 100. Okay, and we'll take two scenarios. The first scenario is a situation where the underlying spot is at say 130. Is at 130. Okay. Now in that scenario, the payoff that you'll be getting is basically going to be, and please now look at the point, the final payoff that you will get, because your option is in the money. Okay, it is going to be 130 minus 100 minus 10. Sorry, minus 11. It's 11, my bad. Now why 11? Why 11? Because this was the premium which you're paying at the maturity, right? So whatever benefit, whatever in the money you are, you should ideally get that money, but you'll also have to pay the premium, right? The A part that you will pay at the maturity. If the spot is at higher, that means in the money situation. Okay. Now, if I look at the other example, suppose the second situation, suppose the spot is going to be, say for example, at 90. So in that case, we are out of the option. Now in that case, the payoff is going to be, ideally going to be negative 11. Sorry, it's negative 11. Why negative 11? Because your option is out of the money. So definite, you still have to pay the premium, right? The only difference is you're not paying at the start, you're paying at the end. So negative 11 is the answer. Is everybody okay with this example with the number? Clear? Okay, I'll take you back to the book now. So now, I'm just connecting it back to the numbers that I've taken. So over here, the actual premium was 10, but now since you're not paying at the start, you're paying at the end, so you have to pay 11. What was that 11? This A, right? And suppose if at the maturity, if your option is in the money, it's going to be ST minus X minus A. But if it is out of the money, you still have to pay minus A. So the main point over here is we call it as deferral. Deferral is the main point which you don't see in the normal option. Right? So kindly read this paragraph properly, okay, and remember this concept for the exam.